But as the equity market opens in this final full trading week of 2025, let's talk the markets. And joining me now is one of our regular guests, Eddie Gabor. He's a co-founder and CEO of Key Advisors Wealth Management. Eddie, great to have you on the show this morning. And I want to talk about where we stand in this market heading into 2026. What's your view?
So we think the setup heading into 2026 is very strong going into the first quarter. And frankly, in this ever-changing market environment, trying to predict farther out than quarter after quarter is really difficult. But when you take a step back, we've had a lot of challenges in 2025 that are now behind us, in our opinion. And as we look at year-end setup and going into January, we now have a Fed that is much more dovish than the market had priced in just a week ago. That's going to be buying $40 billion of bonds per month until April. So that means, in our opinion, that the 10-year Treasury is going to have a cap on how high it gets. To us, the bond market's going to be very critical to follow. So going into January, we're going to have an economy that's reaccelerating while the Fed is being extremely accommodative. And that's a very rare setup to see. So this broadening out that we've seen in the market, we think is going to continue and probably outperform technology, frankly.
Interesting. So outperform technology is your call there, Eddie. What specifically do you like in this market and why?
So the two biggest winners by the Feds, I'll call it pivot to be more dovish. First is small caps. And small caps have broken out both technically and fundamentally and have hit recent highs that we haven't seen since 2021. So small caps, in our opinion, are the top pick for the next 3 months in regards to outperformance. And secondly would be financials. Financials, again, in this regime of interest rates being low and accommodative Fed should do really well for financials. So when you look at financials, you look at small caps, and then one last one I'll throw in there that's more of a contrarian play that we've just recently bought as home builders. They're interest rate sensitive plays, and we think inflation is going to trend down, interest rates will stay capped, and growth accelerate. And we think those areas can do really well in that environment.
Good to know there, Eddie. I do want to talk about some of the economic data that we'll be getting this week. You rightfully mentioned the Fed and its dovish stance, and certainly we saw for 2026 last week, it upped its growth outlook, tempered its inflation expectations. Tomorrow we'll get the jobs report and retail sales. On Thursday, we'll get that inflation data. What is your expectation, as we have seen some weakness in the jobs market throughout the year?
I think the labor market will continue to show some weakness, and weakness is okay as long as we don't start to see a real big acceleration in unemployment. And the interesting thing is some of these jobs are being lost to AI, and those jobs probably won't come back. So we're in an interesting setup where you could see the labor market stay weak, but productivity in corporate America actually going up. And that's kind of where we're seeing here. So inflation, in our expectation, is we think is going to trend down over the next few months. So you do have this kind of Goldilocks environment where the labor market is going to stay weak, which means the Fed will stay accommodative, and inflation trending down is also going to be another win for the Fed to, again, stay accommodative going into the next few months. We'll have to take a look. My biggest concern is if we get too hot economically and inflation reaccelerates in the back half of next year.
Yeah. I know you mentioned earlier, Eddie, you are expecting to evaluate, it sounds like, your portfolio on a quarterly basis. Given this current environment, what will be the biggest factors behind any decisions that you make in your portfolio?
The biggest thing we really will watch for 2026 is the 10-year Treasury note. A lot of people think just because the Fed cuts rates that the 10-year comes down. It does not necessarily work that way. If we start to see the 10-year break out and head towards 4.5 or 4.7, that's going to be a real signal for us to start pivoting out of our more aggressive stance and start to play defense. Because when rates do accelerate, that's going to be a problem for the market in the short term. And that's when you see those 15, 20% drops like we had earlier in 2025. So I can see a scenario where that plays out at some point in time next year. If it does, we will quickly pivot and start playing defense. But right now, it is an offensive game book that we have, and we think that's going to prove to be a big winner over the next few months.
I know when we spoke earlier this year, gold was a big pick on your radar. Has that changed at all?
It has not. Gold has really been one of those assets that work in a bear and bull market in this new market environment. When you think about a scenario where the market starts to get concerned about growth, a lot of times you'll see a rotation into gold, so you have some natural demand there. So gold has been in our portfolio since the fourth quarter of 2024. It's been in all year this year, and we're going to continue to have that position in 2026. So it's been a real alpha generator for our defensive side of the portfolio because bonds have been very, very challenged, and gold has been a nice complement to our bond holdings to help generate the returns we're looking for.
If you do turn to a more defensive stance, what would that look like?
You know, we would have to look at the dynamics, but the general playbook many times would be rotating into things like staples, healthcare, utilities, a healthy money market / cash position in portfolios. And you could also see a scenario where we increase our already overweight gold position as well, too. So that is a lot of times a rotational shift you'll want to make. And again, I think the key is to make sure you do have dry powder in that type of scenario, so that way you can buy any type of big drop that may happen.
Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management. Eddie, thanks so much for joining me here on NYSE Live.
Thanks for having me.